AI has kind of blown my mind in terms of how fast we can evolve. AI's ability to communicate complicated topics are just amazing.
Welcome everyone to a new episode of The Blonde Dollar. Today we have a guest who has significantly shaped the way we think about investment strategy, financial planning, and the future of retirement. Tom Idzorek, CFA. Tom is the Chief Investment Officer, Retirement at Morningstar, and has played a pivotal role in redefining how investors think about financial planning over a lifetime.
Good things happen, bad things happen. Along the way, we need to make these micro fine-tuning adjustments. And if we can do that, we're going to be in a much better position to maximize our level of consumption and or utility or joy that we have throughout our lives. We just keep learning. It's so hard at the moment with how fast AI is changing and what AI technologies you need to be up to speed on. As individuals, the world is changing and we need to be flexible. Knowledge is power. Just keep learning, keep improving your skill set.
This is The Blonde Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blonde Dollar. Today we have a guest who has significantly shaped the way we think about investment strategy, financial planning, and the future of retirement. Tom Idzorek, CFA. Tom is the Chief Investment Officer, Retirement at Morningstar, and has played a pivotal role in redefining how investors think about financial planning over a lifetime. With an extensive background in multi-asset allocation, human capital-based investing, and retirement income solutions, his research has challenged traditional models, advocating for a more personalized, dynamic, and behaviorally aware approach to financial decision-making. He's been recognized with multiple industry awards, including the Graham and Dodd Award of Excellence and 2 Harry Markowitz Special Distinction Awards for his contributions to portfolio theory and financial innovation. He is also the author of a book that he co-authored with the CFA Institute Research Foundation, released last year, called Lifetime Financial Advice. We're going to be talking a lot about that, of course. And today we'll be diving into his research of, exactly that, lifetime financial planning, why human capital is an investor's most overlooked asset, and how asset allocation should evolve over time. We'll also explore how behavioral finance influences investors' decisions, the future of personalized investing, and whether AI and robo-advisors will reshape financial advice as we know it. So whether you're a finance professional, an investor, or just someone thinking about the future of wealth management and retirement, this episode, I can guarantee you, is going to be packed with high value insights. Thomas, it's amazing to have you here. Welcome to the show.
Thanks for having me.
I'm super excited today. We have so many interesting topics to touch upon. But before we dig into all of that, can you maybe tell us in a couple of minutes, what is it that you're doing exactly today as the Chief Investment Officer, Retirement at Morningstar?
Sure. So within the retirement area of Morningstar, I would say I kind of oversee a giant robo-advisor. That robo-advisor is often white labeled by kind of partners. And so, firms that you would have heard of are white labeling, I'd say, our advice systems. I would say these are not just like robo-advices, what I think of as being kind of focused on the investment part. An element of this type of robo-financial planning is it's somewhat frictionless, working on behalf of that investor, serving as their advisor, making financial planning decisions, and then in a corresponding way, investing those assets. And I don't think the world knows this, but I guess we do this for a little bit more than 2 million people. I think that would make us the largest robo-advisor in the world.
Oh, wow.
And so I oversee that system.
So for those listeners that are not super familiarized with what a robo-advisor is it like self-explanatory? So an actual advisor that is fully a machine, or is it like some sort of hybrid?
So there's different deployment models. Again, I mentioned that we were working with a number of kind of mainstream firms that people would have heard of, where we are the engines that are making those decisions. Those decisions can kind of live in a complete robo world where there would not be a physical person or advisor or call center rep, but many of them choose to make that available for when somebody wants to, speak to somebody. They might have access to some sort of chat bot initially. They'd be able to maybe ask some questions. Again, it's a little bit different at different firms, but they would be able to try to get their question answered. And if they needed to speak to somebody, they would, in many instances, perhaps all instances, have the ability to talk to a live human.
Mhm. So we're going to be talking a lot about robo-advisory today. It's not coincidence that Thomas is on this episode. Why? Well, because Thomas is going to be coming to Chicago in May from the 4th to the 7th of May to the CFA Live Summit to the panel I'll be moderating. It's going to be called the Robo-Advisory Evolution. And if you are into that topic or if you work in the finance industry at all, I would 100% recommend you to come. It's going to be absolutely amazing. Thomas is going to be there. I am going to be there. Many other people are going to be there. And it's an excellent opportunity to network with other finance professionals and discuss about some of the biggest topics shaping the finance industry today. So if you haven't checked it out, make sure to attend or at least to look online the CFA Live Summit happening in Chicago. But so before we dig deep into this whole robo advisory topic, there's another topic I want to touch, which is your book and this whole concept of rethinking lifetime planning. So a lot of people think of financial planning as a one-time exercise. You set a budget, you invest in a 60-40 portfolio, and you hope for the best. But in your work, you emphasize that financial planning is a continuous evolving and dynamic process that should adapt to life stages. Why is it so important to approach financial planning as a lifelong process rather than just a one-time decision?
Uh, So I feel like the question itself kind of is somewhat equating investing with financial planning. And I guess I feel like, when you say set it and forget it or investing in, say, a 60-40, I think that's what maybe people are doing with their investment plan. And again, I guess I would argue that, financial planning is a larger umbrella that should encompass that investment plan. And of course, I think it's just common sense that, people's circumstances evolve throughout their lifetime. They need to update their financial plan. Again, your circumstances at, 20 when you're coming out of maybe school are different than they're going to be when you're 30, when you're 40, when you're 65,
Mhm.
maybe when you're 85. It's going to be very different. And again, I think, the common recommendation is that for those that do work with, let's say, a human, financial advisors, is that at least on an annual basis, you would, go back to your financial advisor, update them on their circumstances. They would update presumably your financial plan, and to the degree that your investments need to involve, that would be contemplated, but as part of the broader umbrella of an overall financial plan.
Yeah, it's true. Like, definitely, like maybe that's a mistake most of us do. But when we think about lifetime planning, that I think we pivot automatically, at least in my case, towards financial planning. But I know there's many other variables in there for sure.
Well, and I think, I think both of us, have gone through the CFA curriculum. A number of us, go on and get like an MBA or something like that. And in my opinion, the way finance is taught, it's really taught from the investment oriented perspective. And when we, move over into, people, humans, we're moving into financial planning, and a lot of the financial planning decisions are, I would argue, an order of magnitude more important than those actual investment decisions. So again, I guess I feel like we should be emphasizing financial planning over investments. That's not to say that investment decisions aren't important. I guess it was in September that Paul Kaplan, one of my frequent, co-authors, we wrote a perspectives piece in the Financial Analyst Journal, really kind of arguing that as an industry, we're putting too much emphasis on the investment piece and then really not enough emphasis on the financial planning piece.
Yeah, I think that that touches upon a very interesting point. I mean, I from from what you're telling me, from what I've seen in your book, like you're basically challenging a lot of these traditional ideas that many people have about personal finance guidelines. If I could ask you, what's maybe one of the biggest myths in financial planning that you think people need to unlearn or at least revisit or think about differently, what would it be?
Um, you say myth. I I guess I wonder if I might call that a bit more of a mystery than a myth. And to me, the mystery is really that within the world of kind of financial economics, there's two giant theories in which numerous prizes have been awarded. And I'll start with modern portfolio theory or mean variance optimization. So this is the work of Harry Markowitz. This is the efficient frontier. And everyone that goes through the CFA program, everyone that pursues uh, an investments class, whether it's at the undergraduate or graduate level, this is going to be front and center as part of that curriculum, and they're all familiar with that. And it,
Mhm.
there's another branch of financial economics, which is really kind of the life cycle hypothesis or life cycle, finance. And I'm going to say close to 10 Nobel Prize winners have done critical work in the field of life cycle finance. And sometimes people say that life cycle finance is the way an economist would really approach financial planning. And yet,
Mhm.
so you started with the myth, and I'm turning this into a mystery. To me, the mystery is that how can this fantastic body of knowledge, life cycle finance, almost be unknown by the practitioner community. And so to me, that's a bit of a mystery. And I did say I might pile on there and say a secondary mystery to me is that there's this wonderful body of life cycle finance. Again, numerous Nobel Prizes have been awarded in this area. And we've gone, nearly 75 years, and that type of theory for helping investors has not been, let's say, joined with modern portfolio theory or mean variance optimization, if you like to call it that. And so, to me, again, what do people need to do? I think that we need to think about you know these great theories from financial economics, one of which, again, is life cycle finance. And then maybe a secondary question is how do we join that with the part of finance that so many of us know, modern portfolio theory?
And couldn't it be that there's this gap you were alluding to in the finance professionals community regarding life cycle finance, that it's something that is not being taught at schools, in our earliest years, like I'm talking about teenagers and so on, and only people start to learn about this very much later in their life and careers.
Absolutely. Again, I guess to me, how do we, improve financial literacy? That's a big question. Um, Again, I don't know quite how to fix that, but at least as within, say, the CFA curriculum, maybe, the
Mm,
CFP oriented curriculum, at, graduate and undergraduate levels, to me, people are learning investments, and that's great and important. But so often there's this, in my opinion, this gap where the elements of financial planning to bringing in kind of the human challenges that we face when planning and working with people that have different behavioral biases. How do you help them throughout their lifetime? Where the presumably the goal is some lower level of relatively smooth
mhm,
real consumption throughout their lifetime.
mm. Well, a big part of it, of course, will come from being proactive and looking for quality readings out there, and of course your book is something that comes to mind. By the way, we will put a link to Thomas's book in the description of the show in case you want to give it a look afterwards. But precisely in your book you emphasize that financial planning needs to be adaptive rather than rigid. And my question for you is, how should people think about this whole financial planning thing when so much of life is so unpredictable?
Well, unpredictability, uncertainty. Again, I going back to life cycle finance, and I guess my assumption is that not many people are familiar with it, but there's a giant body of economics that is all about how do you attempt to make optimal decisions in the presence of uncertainty. Um, and again, kind of the area where this is a, kind of expected utility theory, and I guess I sometimes think of life cycle models as being kind of like, the IBM Big Blue, perhaps a little bit like an AI supercomputer with this ability to kind of think about all the possible outcomes that could occur. And in light of that uncertainty, make the appropriate decisions at that moment in time. And then life happens, right? Good things happen, bad things happen, the market goes up, the market goes down, interest rates change, etc. And along the way, we need to make these, micro fine tuning adjustments. And if we can do that, we're going to be in a much better position to, let's say, maximize our, level of consumption and or utility or joy that we have throughout our lives.
So basically, being a little bit more flexible in our approach than what we used to be in the past. Then,
Uh, Again, I guess I have no idea how flexible people are or not, but I think that having a system that is constantly updating and making
Mhm.
micro course corrections to me is again, I guess, more flexible, more dynamic. I don't know if the people necessarily have to be more flexible, but again, rather than making, kind of reviewing something, say, once every 5 years and making giant changes, in my mind, it's much easier to have essentially a live system that is updating in real time and making micro adjustments on behalf of, let's say, a client or investor throughout their lifetime.
Yeah. For some reason, when you were talking about that, the idea of um, dollar dollar cost averaging and compounding came to my mind. Like making the analogy to investing. Like if you just make an investment every 10 years, there's a huge difference compared to whether every year you put a little bit of money and you let that money compound over the decade. And I feel like by doing what you just said about having a more proactive, more dynamic approach to your financial planning, the great thing is that it compounds over the years, and that's how you can reach better outcomes, I guess.
Yeah,
Um,
absolutely.
so obviously you've spent a lot of time researching the field, and along the way you probably came across insights that challenge even the way you saw things in the past. So what's one concept or a principle, a financial planning principle that you used to believe in, but that later changed over the years, or at least on which you change your opinion on?
Um, hmm. But now I'm going to switch from financial planning maybe back to the investment world. When I was first getting interested in finance, I would go to using, I'm going to date myself here. There was, this online, service AOL. I mean, a number of people used it if you're older. And kind of an area within AOL was the Motley Fool. And again, reading the Motley Fool helped, educate me a lot about finance and, uh, kind of started my journey and excitement around finance. But I think one of the books that I had read, that they would have been associated with, talked about kind of the dogs of the Dow and how you can kind of, filter, the Dow 30 and then pick, just a handful of these Dow 30 stocks. And so, again, I guess I probably when I was starting off, kind of this idea that individuals would be, picking individual, securities, ending up with perhaps a highly concentrated, portfolio. Um, I'd say when I first started out, that seemed like, a very reasonable way and perhaps a way to make a lot of money, but it's also a very risky strategy. And I'd say, I probably look down upon that type of approach at this point.
Mm, that's a good one. Yeah, the AOL times are long gone, but yeah, for
Well,
sure.
thank
Like
goodness.
a lot of us still remember that. So a big part of life cycle finance has also to do, I believe, with human capital. So in traditional finance, we talk mostly about stocks, bonds, portfolios, and so on. But in your research, you highlight often that human capital, which is the present value of your future earnings or earning potential, I guess, is often a person's most valuable asset. But most investment strategies, as we know, ignore that. I don't know if it's because it's hard to model or for something else. So, why do you believe human capital should be a key factor in financial planning and investment decisions? And how can we really account for it?
Right. Well, there's a lot there. So I mean, I think, maybe temporarily just going back to the way our curriculum is structured, right? We're not taught in schools or in our curriculum, um, very much about human capital. And again, we don't have that type of capstone class that is saying, how do you bring all of the different, specialties that you've learned throughout your education and put that into a cohesive type of financial plan?
Uh-huh.
The notion of human capital, this of course isn't my idea. This, is attributed to many of the people who've won Nobel Prizes. And again, I think they would correctly argue that it really is this, critical asset. If you think about, why is it that you're, as a young person able to perhaps, take out a loan to purchase a car or maybe, apply for a mortgage and buy that first house? Why is it that that can even happen? Well, it's because you have human capital, and that lender is essentially recognizing that you have this, lifetime of earnings sitting in front of you. And that ability to earn money is what's going to enable you to pay off that loan. Again, often I encourage people to, think about, what are the cash flows of their human capital like? Is that is that producing steady, bond like, income? And for many people, there might be a variable component, but there's a pretty consistent, steady element to that. And it really serves as part of their broader, we sometimes say total wealth. And they have this fantastic hidden kind of off balance sheet, although I think they should put it onto their balance sheet, asset.
So for our listeners, what are the practical ways one can incorporate? Well, one, first of all, how can we measure this human capital? Are there any tools? Is it something that we can read on your book, or how on earth does it work? And two,
Right.
yeah, how can we incorporate this into our financial decision making?
Right. Well, wouldn't it be wonderful if all of the desktop tools that we had, had an ability to say, tell me about, how much compensation you make, the nature of your compensation, where's your career, and then it would help you calculate what is that mortality weighted net present value of
Uh-huh.
this, lifetime of cash flows. So you brought up our book. If again, I don't know what the uh, show note link might be, but if you go to the CFA website, where there's kind of the homepage for our book, there's different materials, and some of them are videos on just trying to teach the material in the book. But there actually is a spreadsheet, so a little tool that for people that were really interested in this could download this Excel spreadsheet and put in a few numbers, and they'd be able to get to see kind of a capitalized value of somebody's human capital.
Oh, I love spreadsheets, and I didn't see the Excel, so I'm definitely rushing to the website
All
after this
right.
conversation, and I'll try it. I'll let you know how that goes. Um, so how does career risk really impact this human capital? Because I guess if an investor is in a stable industry, like being a public servant or like in healthcare, they might be able to take more investment risk. But if they're in more volatile industries like tech, for example, you might need to think about this whole thing differently. How should someone's career stability and earning potential and the industry they work on influence their choices then? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Sure. We kind of in this area, there's if you dig into anything, right, there's always more to read about something. So one of a great book and one of my favorite, kind of researchers in the space is a guy out of York University, Moshe Milevsky. Perhaps you've heard of him. He wrote a book, and it's in the title of the book. I'm pretty sure. I think it's "Are You a Stock or Are You a Bond?" Um, and he tells all sorts of great stories in there and kind of gives examples. And so to me, and if you're, say, a government employee, maybe not these days. Historically, if you were a government employee, you're at least in the United States, your job was, quite safe. Maybe another example would be if you were a professor, like he is, like tenured university professor, um, no matter kind of what's going on in the economy, your job is quite safe. And if you think about your paycheck, how stable are those cash flows? What interrupts them? Do they vary over time? Well, if they're super stable, you're probably more like a bond.
Yeah.
If you are, again, I think a quintessential example is, are you like, an investment banker or a stockbroker where your earnings are really kind of moving up and down with the stock market? The nature of your human capital, might be that you might be, more stock like. In terms of average people, so uh, I worked for Ibbotson Associates, which was kind of a leading kind of asset allocation shop. It was acquired a long time ago now, but I guess 2006 by Morningstar. That's how I came to work at Morningstar. Um, and when we were first working on this kind of robo-advisor system, it actually predated me. It was in the late 1990s that they started building the system. They had this kind of outside advisory group that it contained Harry Markowitz, Dick Thaler, Danny Kahneman, and they were trying to really decide kind of for the first time, how should this robo work and how does it incorporate kind of human capital into how somebody's financial capital perhaps should evolve over time. And they said, kind of what came out of that conversation was is that people a lot of times have human capital that's a bit like a junk bond.
Mhm.
When things are going well, your career is producing very steady, safe, bond-like assets, and then when there's some sort of interruption, if you think about how a junk bond or high yield bond trades, all of a sudden it gets more volatile and it's a little bit more like an equity. Nobody likes to be told, hey, you know, you're you're like a junk bond. And so they, kind of something that came out of that is that the average or the typical person is frequently modeled as being some combination of stocks and bonds, where it's more bonds than stocks. But again, you don't need to model necessarily human capital as a singular asset.
I wouldn't mind being called Mr. Bond, but Mr. Junk Bond, that's a whole different story. That I will not take it. Um, so talking about the people's jobs and the industry they work in, what's your take on investing too heavily in the industry you work in?
So from a human capital perspective, well, maybe I should bet, so if you think about your total wealth, what is your economic worth? Again, to me, you have your financial assets, and then you also have this, again, the hidden asset of human capital that we've been talking about. And again, everybody's familiar kind of with that kind of investment story. Well, within investments, right, we're looking to add uncorrelated assets or we want to diversify our portfolio. And so for you as an individual, you want to diversify your total wealth, where your total wealth again is your, financial capital and your human capital. And so for many people, you should not be, investing in, you should not have company stock in the in your employer. I think the quintessential example is like, Enron employees. So Enron ends up, collapsing. People lose the source of their, human capital and have to go find a new job. And many
Mhm.
Enron employees were actually in their, retirement plan investing in Enron stock. And so at the moment Enron collapses, their financial assets take a giant hit because their Enron stock, went to zero, and then all of a sudden they were out of a job. So kind of the basic concept of, diversify, diversify, diversify holds true. And when we think about, our human capital and our financial capital, we can't really change the nature of our human capital very easily, but we can certainly change how we're investing our financial capital. And we'd want to do that in such a way where we are not investing, let's say, in our employer or perhaps even the sector in which we're working.
And is there a magic formula to maximize, I'd say, or find the right allocation between maximizing the human capital and the financial capital? Because a lot of young investors particularly focus on getting the highest return possible in portfolios, but investing in your own skills, education, and things like that often provides greater returns over a lifetime. I think that it was Benjamin Franklin that once said an investment in education pays the best interest. I'm not sure if it was him, but I always thought it was a good quote. So, how should investors, and particularly young investors, think about balancing traditional investing with investing in yourself and your human capital?
Oh, that's a great question, and I don't know that I have a great answer. Again, like I know that like for yourself and myself, we've both been through the CFA, program, and so we were investing in ourselves. That took time, and again, and at least I'd like to think in my case, and I'm assuming in many cases, that has kind of paid off. So, getting an education, having that ability to earn more money, is a great thing. It's kind of a separate problem given whatever level of human capital you have in the nature of that human capital. Again, is it more stock like or bond like? Um, you can't really change that. Again, maybe you could, but most of us we're going down a particular career path, and the way in which we're compensated is, either nice, safe, steady cash flows, or perhaps it's more volatile. And
Mm-hmm.
given that we can't change that, really the lever for how we should adjust our total portfolio, a total portfolio that includes human capital and financial capital, is to adjust how we're investing our financial capital in light of the nature of our human capital.
So, you were comparing, our jobs and even, like, I could argue, personalities to different asset classes before, but how does all of these also link to life stages, and how should asset allocation and risk management evolve as a person most through different life stages? Could it be that yeah, human capital is something that we should do earlier in our careers because the compounding effect is maybe going to be greater than just the pure traditional financial type of investment?
Um, well, I do think kind of what I sometimes call the financial capital glide path. So this would be almost like think of a target date fund, perhaps.
Mhm.
What you're doing in your financial capital is largely dictated by the ratio of human capital to financial capital. And we don't, as individuals, we don't have that much control over the size of our human capital. So what is the, mortality weighted net present value of all future earnings? Um, I guess if you think about a young person, 20, 25, just coming out of school, most 25-year-olds that I know, they just haven't had time to save much in the realm of financial capital. In fact, they probably are, saddled with student loans or other forms of debt. And so if
Mhm.
you think about kind of the asset side of their balance sheet, they almost have no financial assets, but they have one giant asset, the one we've been talking about, this hidden asset of human capital. And again, for most people, the cash flows that that's going to provide are more bond like than stock like. So again, from a total economic worth perspective, they're not particularly diversified, right? They have this
Yeah,
giant bond that they're sitting on. And luckily for them, it's probably an inflation adjusted bond because salaries tend to go up with inflation. And
yeah.
they have this very small amount of financial capital. And so to diversify between this giant bond and your financial capital, chances are the vast majority of your financial capital should be invested in equities.
Mm.
And then, you're going to go through life and hopefully people are disciplined savers. In some portion of that paycheck each month gets saved so that you will eventually be able to pay for consumption in retirement. And at some point, there'll be kind of a point of inflection in which hopefully the amount of financial capital that you have will actually, be much greater than your human capital. And then once in retirement, and let's say that your human capital is mostly depleted, well, that's where you're going to pay for your consumption using the nest egg that you've built up throughout your life,
Uh-huh.
your financial capital. And, just frankly, that's what life cycle finance is all about, is how do you take, your kind of productive working years in which you're able to earn an income, and that helps you buy things and pay for consumption, convert that to a portfolio of financial assets that can eventually be used to smooth consumption throughout your unknown, in terms of length, retirement.
Yeah, I love that. How to transform your brain into actual tangible money. Um, but so clearly you spent so much time thinking about this, researching, writing about it. Why on earth are we not talking more about this concept of human capital? Quite frankly, I mean, before this conversation and doing my research and all of that, I had the feeling I didn't know enough about this, and it feels like really really important now that I'm aware of it.
Yeah. I think it's super important. And again, I think it's, again, like I said, it's a mystery, right? That this is not front and center in our education in terms of the world of finance. And my guess is there's a couple of reasons for that. For so long, we were in kind of a defined benefit oriented system where you'd work for an employer. It could be the government or a corporation, and they would offer a defined benefit plan. And that play as you worked, you would accrue a lifetime of benefit, and you didn't have the burden of having to invest you know on your own. It would be nice, of course, if you did, but at retirement you would receive a pension, often with a cost of living adjustment. And so as we've kind of moved away from that DB, defined benefit system, to a defined contribution system, the risk of investing has shifted from that employer to the individual, making kind of financial planning so much more important. Maybe another thing is, the Markowitz mean variance optimization. Markowitz, created this in the 1950s. It uses, quadratic, programming to solve that problem. And that is something that, early on, whether it's 1960s or 1970s, as rudimentary as as computers were, it was a problem that you could easily solve, right then and there. It
Mhm.
was in the 1960s that people like Milton Friedman, Paul Samuelson, Gene Fama, Franco Modigliani, et cetera, were working on life cycle finance. But the solving of the life cycle finance problem, involves something called dynamic programming. And sounds similar, but it's different. And the solving of these problems is extremely hard, even today. With computers that are vastly superior to what we would have had in the 1970s. This is life solving kind of the life cycle optimization problem with the millions of possible outcomes and permutations along the way. It's a very difficult problem to solve. Although I would argue, we've figured out different ways to solve it with perhaps simplifying assumptions in a reasonable way. But you know, uh, I think it was kind of this two-part problem where the DB world, people just weren't interested. You didn't need to solve this type of problem because the
Mhm.
pension was going to pay for your retirement. And then computationally, one you could not put a desktop tool in front of an advisor and let them unleash the power of life cycle finance. And again, what's neat now is that all of a sudden we've arrived at a point where we really can unleash the power of life cycle finance, but we've forgotten about this amazing body of knowledge from financial economics, and we need to bring that back front and center into the curriculum.
So, how do you think now that we are in the age of AI, this whole field is going to evolve? Because now it seems like sky's the limit, and really computational resources, as you were saying, are they're really not a constraint anymore, or we have a lot more capabilities. So, do you expect to make um, academia to make breakthrough discoveries over the upcoming years? And are we going to manage to make like the best fully personalized models and so on in the future, or is that still just like a dream?
No, I mean, I don't, I mean, I think it's here and now. And again, in terms of the degree to which financial advice will be improving, um, it's just amazing to think about. Again, I guess so. I would just say, like, AI has, kind of blown my mind in terms of how fast we can evolve. And I think it's just, super exciting. If I think about when I was, perhaps in my 20s, access to quality financial planning, that was, of course, one could go try to, search the internet, and searching the internet at that time, Google wasn't the search engine of choice, didn't really exist. It was much harder to find, I'd say, curated advice, especially personalized advice. And we
Mhm.
are entering a world of hyper personalization with probably fantastic advice. Maybe at this moment, the industry has not quite evolved or changed, but you talked about academia. Again, it seems to me that we are at the cusp of just giant leaps forward in all sorts of industries, personal finance being one of them.
So the $1 million question, Tom, am I gonna lose my job in 5 or 10 years down the road? Is AI gonna replace me? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Um, no, at least not 5 or 10 years down the road. But the need. So again, my understanding, I think you're in financial, advising, and perhaps working with clients to some degree. You know, there is a group of people that will always feel more comfortable talking to a human. Um, Now, the advisor that is advising to the client, my guess is that their reliance on AI enabled, advice systems, you know, is going to come much higher. So again, sometimes I think about, 20, 25 years ago, the typical financial advisor thought of themselves as an investment, guru. And what's happened over the last 25 years is that many of these people have, begun to, outsource perhaps to the dealer group, to the home office, kind of the heavy lifting of the investment decisions. And so we've been kind of
Mhm.
in this long drawn out, kind of movement of outsourcing to other decision makers. And of course, that outsourcing to systems, AI expert systems, AI, generative AI oriented systems. That's just going to continue. And but again, I don't think that you're going to be out of a job, but the number of people that are meeting with clients as a financial advisor, I think that there's a time, and I don't know that it's 5 or 10 years from now, but 20 years from now, where I just think that there's less people that are going to feel the need to have to meet with an individual. I think about my kids are in their 20s. um, they would prefer to work, to get almost advice from their phone or from the computer than to go speak to somebody. And I think that that'll be indicative of a lot of people, 20, 25 years from now.
So, how do you imagine the financial advisor of the future? Like, is it going to be someone that, yes, maintains a part of that relationship with peers and clients, but has like superpowers to do crazy stuff in terms of maybe the number of asset classes he or she covers, the number of research he or she is able to write, or is it something else completely?
Well, I mean, I think that that's somewhat mixing, kind of what an investment analyst researcher might do relative to, a financial advisor.
Mm.
I guess if we stick with financial advisors, they're going to be empowered with wonderful technology. Maybe they already, again, relative to 25 years ago, they have fantastic tools, and these tools that they have at their disposal are going to be, much better. And if I think about kind of the evolution of where financial advisors and financial planners are, I think they've become more of, a coach, you know, that they're no longer thinking of themselves as the true guru in terms of where did the advice come from. They rely on the home office. I think moving forward, they're going to continue to rely on the home office, but rely on expert systems to help, that's providing the advice, and they are kind of more of the communicator of that advice. Now, I will say, the AI's ability to communicate complicated, topics, are just amazing, and will be getting better. So again, overall, like in terms of like a career, you know, I I don't know that I would choose financial planning, as something that is probably going to exist as we know it, for the next, if I was just starting out, I don't think that I'd choose that as my job. Again, in terms of designing the systems that many millions of people, perhaps billions of people will use, I find that quite exciting.
You know, you lost me when you said that my job is safe for the next 15 years. I just started to think about that. I was like, okay, fantastic. I'm safe for the next decade. But
Well,
after that, like it's wide open. I'm like, oh my God, what am I gonna do with my life?
well,
And
so I mean, I question whether my job will be, well, probably, maybe I'll be just retired, but I am a big fan of, just keep learning, right? So that like it's so hard at the moment with, how fast AI is changing and what AI technologies you need to be up to speed on. But I think as individuals, the world is changing and we need to be flexible, and, kind of knowledge is power. And so, you know, my advice to listeners is just keep learning, keep improving your skill set.
I'm 100% with you on that. I mean, I was joking. I'm very upbeat about the future. Actually, I think I'm an optimist. I don't think AI is gonna replace us. I think the nature of jobs is just gonna evolve. Obviously, I'm with you also. I think some jobs are gonna be more protected. Everything related to empathy, obviously, is gonna be easier to yeah, they're going to have less issues competing with AI, at least in the first stages. We'll see how that evolves over the next few decades. But if you have an open mind and you keep learning and trying things and stay on top of all of these and become part of the change rather than just staying oblivious to it, there will be one way or another for you to use this technology and find a place in the future workplace. I have no doubt about that. At least that's how I chose to think, because otherwise I get depressed. So I'm excited, and I think it's gonna be really really fun to see all of this happening in real time, really. And that's also, by the way, one of the reasons why I decided to launch this podcast. Keep learning, keep acquiring new skills, keep meeting people, do things that you're passionate about, and keep moving, really, and things will naturally uh, get together. I think. From a client perspective, though, how do you think this whole AI wave is gonna materialize? Do you think, again, talking about financial advisors, from the client perspective, is it going to be that they receive more information? Is it going to be that they receive more personalized, outcomes, or is it going to be something else?
Um, like, well, I think it's all of those things. It is something else. It's, perhaps better advice. I do think it'll be hyper personalized. I think it'll evolve, more quickly as circumstances change. Again,
Mhm,
just all around better advice. So, for the person that wants more information, they'll be able to get more information. It'll probably be the information that they're really seeking. So
mhm.
again, like a lot of times, right, if you're searching, finding the right document, finding the right information, the answer to the specific question that you have, it has been hard. I feel like getting, exactly the right answer that you're seeking, is getting so much easier and so much faster.
Yeah, I think the speed variable is definitely going to get significantly better. And I'm very, very excited about that. Um, an important topic related to all of the things we've been talking about since the beginning. So, life cycle finance, human capital, and even AI and the future of the industry is behavioral finance, which I believe touches upon everything. Um, So I'd like to pivot a little bit towards that theme now and ask you a few questions about that. So traditional finance assumes that investors are rational, markets efficient, and so on. But you said it at the beginning of the conversation, things don't always happen according to the plan, and real world investors make emotional decisions. They can chase trends, they can miss price risk, and so on and so forth. So in your opinion, why do you think traditional finance models fail to fully explain uh, how investors actually behave?
It's a good question. I don't know that I'm the expert to talk about this, but so absolutely, people are not, they're not supercomputers all by themselves. We all have biases and limits to, the quality of decisions that we can make. I think that's where kind of the role of the advisor is so critical, helping that individual to make, rational decisions. And again, I guess to me, our book, we are, I'd say creating a rational normative model for how an investor should behave to, again, maximize kind of their joy, their happiness, through financial planning and investing. Um, and so again, I guess to me, I think the two can coexist, and at some level, they're coexisting at kind of at war with each other, and the right, we're our own worst enemy. We're in danger of shooting our own foot off, and hopefully, with whether it's an actual advisor or an AI system helping an advisor, you'll be able to predict when are investors getting nervous, when are they in danger of making a bad decision, and how do you coach them through that? So, just again, exciting times.
Yeah, 100%. And one of the reasons why I wanted to get into this topic is because while I was doing the research for this episode, I discovered a term that I never heard about. So I knew about the CAPM, capital asset pricing models, but I didn't know about the, I don't know how to call it, PAPM with P,
Yeah,
which
we
would
call
be
it, right, PAPM.
PAPM, Popularity Asset Pricing Model, which basically tries to bridge the gap between classical and behavioral finance. And instead of assuming that investors just care about risk and return, this model recognizes that investors actually have different preferences. Some are more keen to buy stocks, others not, and so on and so forth. So can you tell us a little bit more? What is PAPM and how does it improve the traditional asset pricing models like CAPM?
Right. Well, so now we're definitely moving away from kind of financial planning, and into, another area of economics that's very exciting is, asset pricing. And I would just say the textbook, asset pricing model that we learn in the CFA curriculum, and it's in every investments textbooks that I've ever seen, is the capital asset pricing model. Um, and for those that are, kind of follow the capital asset pricing model, there are people that, believe that it has kind of a number of, shortcomings.
Mhm.
And actually, Gene Fama and Ken French, they wrote a 2000, I think it was 7 article, Disagreement, Tastes, and Asset Pricing, in which they were kind of identifying what they thought of as the two biggest weaknesses of the capital asset pricing model, which is, from their perspective, that it doesn't account for disagreement. So in the CAPM, it is assuming kind of efficient markets, and that 100% of people agree on what those capital market expectations should be. And of course, there's no way in the real world that all of us agree on what the expected returns and risks and correlations of all the different asset classes are going to be. That's just, kind of a clear weakness. And another element that, Fama and French, pointed out was is that, you know, investors have, preferences or tastes that go beyond just risk preference. And as such, that moves asset prices.
Mhm.
Well, so Fama and French didn't create an actual equilibrium asset pricing model. They just highlighted these two weaknesses of the capital asset pricing model. And so, along with Roger Ibbotson, Paul Kaplan, and James Zhang, We wrote another book, and we have different, articles that are published kind of on this topic, which is how do you improve upon the CAPM, and that's with our popularity asset pricing model, and it basically allows for disagreement as well as the idea that people have tastes or preferences, and those tastes and preferences, if they're shared by enough investors, they begin to influence asset prices.
Keep an eye on Tom. He might win the next Nobel Prize of Economics thanks to the PAPM. I'll certainly do. I'm excited. Let's see if that happens. But yeah, you were highlighting some of the shortfalls of the CAPM. Do you think it will ever be replaced, or is it now just like going to be a part of finance education forever?
I think it's going to be part of finance education forever. And so, even though I'm trying to write or create models that improve upon the CAPM,
Mhm.
I do believe the CAPM is, it's beautiful, it's elegant, it's simple, it's easy to apply. It is kind of the baseline model and serves as it's a wonderful baseline model. So I think that it'll be here forever. I so hope that, again, I'm always, I guess a theme for today is I'm wanting to change the curriculum of this and that. I so hope that alongside in these textbooks or curriculums that the popularity asset pricing model would become the next chapter or part of the same chapter, and part of the curriculum.
Well, let keep us posted. Because yeah, I think for sure. Like, I guess the beauty and the curse of these type of models like the CAPM is their simplicity. So as you say, very elegant, super cool to be able to learn about it in a couple of hours, and you feel like that's it. You understood how markets work, but then you realize that the world doesn't always behave the way these models are telling you it should. Um, so I want to pivot now to a different part of the finance industry. I mean, you are the CIO of Morningstar Retirement, so we cannot have this conversation without talking about retirement. So let's dig a little bit into that. First question for you: do you think traditional retirement planning models are outdated, or do you think you know um, they're still very valid?
I, you see, I don't even know that I know what the traditional retirement planning, I don't know, systems are. So it's hard for me to say that they're outdated per se. My guess is that we're frequently guided by heuristics or other items where, in my opinion, we really need, rich theoretical models to base our decisions on. And again, I will point back to life cycle
Yeah.
finance, which isn't just about accumulating assets, but it's about retiring and having smooth consumption for as long as one lives.
So maybe let me get a bit more specific. Like most retirement planning follows the 4% rule, assumes a fixed retirement age, relies on static asset allocation. But now people are living longer, they're working longer, they're facing more financial uncertainty than ever before. So with those in mind, do you think, yeah, the whole way we think about retirement planning has to change too, or not?
Um, well, does it have to change? I don't know that it has to change, but we could definitely do better, right, than the static 4% rule. And again, I would argue that the types of systems that we're promoting in methodologies that we're promoting in our book is one in which people are arguably more flexible. Again, I described kind of IBM Big Blue, thinking about all circumstances as the world evolves and updating what is a reasonable amount for somebody to spend
Mhm.
given these exact circumstances. It's hyper personalized. And so the idea that we can have dynamic or evolving recommendations related to spending, those systems exist, and people should be absolutely moving away from the 4% rule. And arguably, there's that kind of transition from human capital to financial capital, and then that that evolution, continues even after retirement. And so to me, human capital doesn't just disappear at age 65. We have deferred labor income in the
Mhm.
form of social security or some sort of social insurance, depending on where you live. And a number of people, again, if you're retiring today, you may still have access to a defined benefit plan, and so you do have sources of guaranteed income, and it's a wonderful thing.
So intimately related to that 4% rule, which is basically that you can take 4% of your pension savings per year before you die, right? There's the concept of longevity risk, and now people are living longer than ever, which is great. But many retirement plans on the downside don't account for longevity risk properly. So how should people think about this risk, and what's the best way to deal with it?
Sure. Again, I guess I might describe longevity risk. This is the risk of outliving your assets. And again, conditional on the idea that you're age 65, a lot of, kind of a typical life expectancy amount might be to say 85, so a 20-year type retirement. But, the number of centurions, right, is increasing all the
Mhm.
time. So people are living, to 100 to 105. And if you did retire at 65, and, some will retire earlier, some will retire later, but, now you need to plan for 40 years, possibly, of expenses.
So that's something to take into consideration. So you talked earlier in this conversation about retirement glide path. So many advisors use this glide path strategy where people move from stocks to bonds as they age, but this approach might not work for everyone, especially in worlds where interest rates are low, I guess, or going lower. So does this traditional glide path strategy still make sense, or should investors be thinking about risk differently in retirement?
Um, so when it comes to glide paths, at least in the, let's say maybe the target date fund world, there's there's kind of a group of whether sometimes referred to as two glide paths where people they stop gliding at retirement. There's kind of another category or grouping of kind of philosophies around glide paths, which is that even after retirement, one's asset allocation should continue to evolve. And I'm in this latter camp of that as circumstances evolve, we need to continue to evolve how we're investing our financial capital.
And one last question regarding retirement as we get closer to the end of the conversation, and maybe making a link with what we talked about before about psychology and behavioral finance. What are the biggest psychological challenges that, in your view, people face in retirement, and how can we prepare for them?
I again, I guess maybe there's a group of people that spend way too less. They spend enough in retirement, right? They're so worried
Right.
about you know spending their money and depleting it that they don't live nicely enough. And then there's a group of people that are they spend way too fast, and to me that's totally unnecessary. With the type of systems and technology that exist today, they can get personalized recommendations that help them, to really maximize their, let's say, their joy. And they should be using these systems, or at least their advisors should be.
Use the technology out there and talk to professionals. That's wise advice, I would say. So maybe a couple of questions to wrap this up. More personal, Thomas. What's next for you? What are your plans for the next few years?
Well, again, I'm very happy at Morningstar. Again, I'll just say it's just wonderful to work at like a mission driven company where there's this supporting of research, and then behind the kind of the real mission is to help investors. I'm not quite sure what it'd be like to work for a traditional asset manager. Again, I feel very lucky to work for Morningstar, and so uh, working away at trying to create the best kind of methodologies and then bring those methodologies to life in scalable systems that networks of financial advisors can license or use from Morningstar to create better outcomes for their clients.
That's definitely an exciting project to work on. So I'm very happy for you. And one last question: if listeners have to take away just one key lesson from the conversation we've just had, what do you hope it is?
Mm. Well, I think I said keep learning earlier. So again, I think, it's a changing world. Please just keep learning. If you're bored and have trouble sleeping, our book is a wonderful sleep aid. So check it out.
And I'll add a second one. On top of that, make sure you check out the book that Thomas co-authored with the CFA Institute Research Foundation, Lifetime Financial Advice. We'll have the link in the description of the show. Tom, it's been absolutely amazing to have you. Thank you for sharing so much wisdom. I'm very excited to see you in Chicago in very, very soon. We're going to be talking about the future of the profession and robo-advisory in the age of AI. I know you're going to have incredible insights. So if you have the possibility, make sure to come to listen to Tom live. And thank you very much, Tom, for your time. And I wish you all the best for those exciting projects you have.
Hey, thanks for having me.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.